The latest manufacturing data out this morning showing signs of the economy gaining momentum. For more on what that could mean for future Fed decisions in the broader market, we have Jack Manley on set. He is JPMorgan's asset management global market strategist. Jack, thank you so much for coming in studio with us. Talk to me about this PMI data coming in above expectations. How much of a driver is that going to be of the market?
Well, I think markets seem to not be particularly thrilled with the PMI data, but I'm so frustrated, Madison, with this idea that good news is bad news. Like, I think that story is so played out at this point. And I think the problem is that we have totally lost the plot on what interest rates are all about. And we have convinced ourselves that the Fed wants a recession. It does not. That is not in its mandate. The Fed does not want to crush the economy if it does not have to. We're not supposed to be rooting against the economy accelerating. That is a good story. And as long as the inflation data remain relatively in the right place, moving down to that 2% target at some point, as long as the labor market stays reasonably hot, I think that the Fed is going to be able to do what it wants to do this year, which is ultimately cut interest rates. So I'm not paying too much attention to the PMIs. I don't care that they beat. I don't think it's a big story, but that's what markets are all focused in on.
But let's talk about the kind of tenor of your tone on the Federal Reserve right now, because it's a fascinating point, and I think it points to this question about the Fed losing the plot and not really having a driving thesis behind just, oh, we're data dependent, but what does that actually mean?
Yeah, I wonder if the Fed is actually data dependent, frankly. I mean, I don't think the Fed has done a particularly good job of managing monetary policy at all throughout this entire cycle, and I think you have to rewind the clock a little bit, right back to 2022 when they first started doing this stuff. But it blows my mind that quantitative easing lasted as long as it did, that rates stayed at zero for as long as they did. The U.S. economy was fully out of the COVID slump by the fourth quarter of 2020. Why were we remaining so accommodated for so long? If the Fed were truly data dependent, those rate hikes would have happened a year earlier. The end of QE would have happened a year earlier. The Fed is not always data dependent. They rely a ton on forward guidance, which is why they put out these summary of economic projections like the one that we got last week. So I'd rather than trying to like game out exactly what the Fed's going to do, I think it's really, really hard to get inside their heads. And of course, we don't know what the data are going to look like over the next several months. I'd rather focus in on some things that I think are a little bit more tangible, a little bit more predictable as investors. Fed's probably not going to hike this year, right? So we can kind of put that off the table. They seem more likely than not wanting to cut at least once. I don't know if it'll be more than that, but at least once this year. Once they start to cut, they're not going to stop cutting immediately. They're going to continue to cut. And wherever they land is going to be a whole lot lower from where we are right now and a whole lot higher than zero, which is where we were for basically the last 15 years. That allows you to sort of put aside a lot of the short-term uncertainty. I don't know what's going to happen to rates over the next 6 months. I don't know what's going to happen to the data over the next 6 months. But I do have confidence that rates will move lower over that longer-term time period. And that, I think, gives me a little bit more confidence in the outlook for stocks or bonds.
Do cuts matter for the market specifically?
I think if the Fed were to surprise and not cut, that's bad news for the market. But at this point, things are all priced in, especially after last week's meeting, the Fed kind of affirming what the market was already looking for, 25 basis points of cuts. I think if the Fed does cut, let's call it September, October, November, sometime, end of third quarter, start of fourth quarter, maybe, the market's expecting that it's not going to be a party, right?
So then for us to continue to get new all-time highs, I know you expect earnings to broaden out, but we're also seeing some signs of a slowing economy. How do you find that earnings growth amid the potential struggling consumer environment?
It is admittedly challenging. I think we have to remember, though, that the consumer is, in general, still pretty resilient. And a lot of the problems that we see in this consumer right now are disproportionately focused on the lowest income individuals in this country, which is a shame, right? I mean, you have to put that out right up front. That is really too bad. There are a lot of people out there that are getting completely left behind. And that growing divergence between the haves and have-nots is, I think, one of the reasons why you've seen populism become so popular in Washington, right? It's this idea of kind of bread and circuses, because there are so many people getting left behind. But from an economic perspective, the U.S. economy counts the dollars that are getting spent and not the heads that are spending them. And I love anecdotal evidence. I always share anecdotal evidence because I get to see a lot in my travel for work. And I'll tell you, like, the first class cabins on all the airplanes, they're sold out. The hotels are all sold out. The restaurant reservations are impossible to get. Concert tickets are impossible to get, right? NBA Finals wrapped up last week. Like, can you imagine how much a ticket to one of those would have cost and standing room only, right? I mean, people are still spending. The consumer is still doing well enough. And I think that helps to support this broadening out of the earnings story. It's not going to be everybody, right? There's still going to be winners and losers. I think you got to be really, really careful. This is not necessarily a beta trade. I do think you need a little bit of security selection, a little bit of active management. But to me, the biggest story as we look for that broadening out of earnings in the back half of this year is an emphasis on quality in your allocation. This is not a style box story. It's not a sector story. You are fishing in too big of a pond. Quality is what matters because of that rate outlook that we just discussed. Money's not free anymore. And even once the Fed starts to cut rates, it won't be free again.
Yeah.
That, I think, informs the decision.
And it's stock picking. We're going back to that environment where you really got to look at the fundamentals for each investment opportunity. Jack, thank you so much for coming in. Really appreciate it. Great insights as always. Thank you.